Welcome. Good day, everyone. Thank you for joining us. This is WLG Tax and Private Wealth Group. I'm Hannah Shea. I apologize, I'm not on video today. I'm not feeling very well. But for those of you who don't know me, I manage our practice and industry groups. And you have been muted as you've joined. That's just to keep from sort of distractions while others are talking. But if you have something to say, you want to raise your hand or chime in, please feel free to do so. We encourage participation by you guys, and you can use the raise hand feature or turn your mute off to speak. With that, and also I did want to note, we have a few of our Beyond Borders participants with us today. So we are in week 2 of Beyond Borders, which is our 4-week digital program for young lawyers. We have invited them to all of our practice and industry group meetings. I've seen a few of you over these last 2 weeks. So welcome, thank you for joining us. So those of you who are regular tax attendees will see a few new faces, and you are all welcome to turn your videos on as well. One last thing, if you could take a moment to rename yourself by hovering over your video and clicking the 3 dots and selecting rename, or you can find yourself in the participants list and click more and find the rename from the drop down there, just to include your firm name. That will be helpful for us to know where everybody is joining us from. And so with that, I'm going to hand it over to Mark at Davies in Canada, who is the co-chair of the tax group for the Americas. Mark.
Thanks, Anna. I think there's not much more for me to say because Anna just introduced me, but as Anna said, I'm the co-chair for the Americas region. And the plan for today's session is to talk about Pillar 2, which I think most of you know what Pillar 2 is, but I think before I pass it on to my co-chair, I think we thought it would be a good idea to make a very brief summary of the Pillar 2 rule so that everybody's familiar. And I think just the main reason we thought about this subject was, I think we're exchanging emails, and at the same time I was at a conference for IFA and I was speaking with one of our colleagues in Barbados, and we really had opposing views as to whether Pillar 2 was good for our country or not. So with that view, we thought it would be great to get everybody's views on what is going to be the impact of Pillar 2 in their countries. So I think I'm quickly going to pass it on to I think as some of you know, I think I remember some of the names on the participation list, others I don't. But for those who are the first time joining, generally what we do, we host a number of these presentations throughout the year to discuss a number of tax issues. And I think since the last meeting, we had the chance to get a new co-chair for the European region, which is Piotr, that I can't pronounce his last name. So I'll pass it on to my co-chair to present himself.
Hello, everyone. Piotr Andrzejak. Is indeed a little bit difficult for non-Slavic participants of the group. It's nice to meet you at today's meeting. And during the last session, we discussed a little bit of a Pillar 2 idea as a good starting point for opening the discussion. The idea for today's meeting is just to go through very quickly by a short presentation describing the main features of Pillar 2, and then open the discussion about the actual practical implications, what you believe might be the implications in your member states and in your jurisdictions, and what would be how we could use those new rules to serve our clients. So if you allow me, I would just try to put the presentation slides just for everyone to see it. Can you see it? Yeah,
we do.
Good, perfect. So what's Pillar 2? It's actually the global minimal tax. It's an additional tax to be imposed on revenues of companies due to the fact that there are some huge differences between the particular jurisdictions related to actual scope and rate of taxation. The how is it called in practice? It's called global anti-base erosion rules, shortening GLOBE. And there are two main objectives of a Pillar 2 is first of all to expand the BEPS to combat the profit shifting, and secondly to reduce the tax competition among the jurisdictions. In other words, to harmonize a little bit the corporate income tax rates among jurisdictions and to make tax competition more difficult. Those rules within the European Union have been introduced on the basis of a directive which was adopted in December 2022, and that should be enacted into the national legislation by end of December 2023, which means that we have a little bit more, around 6 months for our jurisdictions to implement those regulations. To whom these new rules could apply? They can apply in relation to groups of companies which are seated in more than one jurisdiction. So for multinational companies, having subsidiaries not only in a single state, but also in other jurisdictions, but also to large national groups. The minimum threshold is a turnover of euros 750 million per year. And that is being verified on the basis of meeting this threshold for at least 2 years within the last 4 years of a group, of existence of a capital group. The 750 million threshold is measured on the basis of a group. It's not on the basis of a particular subsidiaries, but it's like an aggregate turnover of a group. So there might be quite many of our clients who could be actually affected by those new regulations. What, in a nutshell, what would be the impact of those new regulations? There will be an impact in a sense of introduction of a top-up rate, the top-up taxation, which would be imposed in relation to income if such income is in a particular jurisdiction subjected to taxation lower than 15%. And of course, there is a lot of a discussion about what is the actual rate of taxation, what should be the taxable base, and that will be subject to discussion upon implementation of those rules. But as a general rule, whenever we are having subsidiary in a jurisdiction where the actual tax rate is below 15%, this top-up taxation may occur. The provisions introduce also the specific model of calculation of this top-up tax, computation of taxable base. And those regulations also include specific measures how to take into account the regular taxation which occurs in a given jurisdiction, and also the national minimum tax regulations which exist in some specific jurisdictions, and all those shall be taken into account in order to calculate properly the minimum tax rate to be applied. There are two, I would say, main rules of those regulations. The first one, let's call it income inclusion rule, which according to which if the top parent entity is located in the jurisdiction which applies those rules, which applies Pillar 2, that means that this top parent company or ultimate parent entity, which is to be responsible for payment of a top-up taxation. But of course, there are also jurisdictions where those regulations shall not be enacted, or which shall be enacted at a later stage. And in relation to those jurisdictions, there is another rule which is called under-tax profit rule, which means that if we do have a group of companies some of them being in the jurisdictions which enacted those rules, and some other with those jurisdictions which have not enacted those rules. This means that the companies from jurisdictions where those rules have been enacted need to calculate at the national level the top-up tax to be imposed, because of course the reason for that is that actually there would be no there could be no possibility to apply this top-up tax by the ultimate shareholder, by the ultimate parent company, which would not be bound by those regulations. The provisions include quite a huge list of exclusions. I think among them, the most important one would be the entities which have sufficient business substance. And of course, what we can expect is, what does it mean to have a sufficient business substance in a given jurisdictions in order to benefit from this exclusion? There are also exclusions applicable to pension funds, to real estate funds, to non-profit organizations or government organizations, and for some specific industries like international shipping industry. So those entities would not be subjected to those new regulations. And finally, there is, I mean, in order to implement those regulations, you need data. You need to collect data from particular jurisdictions in order to be able to assess what is actually the revenues derived in particular jurisdiction and what is the tax rate, effective tax rate applicable in those jurisdictions. So what we would expect is that that would be in line, of course, with Pillar 2, that our clients would face a lot of documenting obligations and reporting obligations. There will be additional formalities to be obeyed, and forms to be submitted to the tax administration, which would allow the tax administration to assess and actually apply the minimum tax. And that would be yet another piece of compliance obligations levied on the subsidiaries belonging to the groups which qualify for the minimal tax. As regards Poland, I mean, because this is in a nutshell what the minimal tax is and when we can expect it. And for just opening the discussion, I think I may start with a little bit of description of a Polish situation. We are members of the EU, European Union, meaning that we are bound by the Pillar 2, and which was enacted within the EU in the form of a directive. Poland is bound to, or is obligated to introduce those regulations to the national legislation by end of December this year. We've seen some preliminary works of Polish tax administration and Ministry of Finance related thereto, but we don't see yet any actual legislation implementing those regulations. So what we can base on and rely on is only the OECD guidelines, but in particular the directive. And when we are thinking about the impact of those regulations on the Polish and broadly speaking European market, at least I think two groups of entities which would be highly affected. First group would be those entities which benefit from foreign investment regime. There is a regime applicable in Poland, but also elsewhere in the EU, where the entities deciding to invest in specific sectors are exempt from corporate income taxation. The condition for that is investing sufficient agreed with the government amount of money. And the advantage is that, that for a specified period of time, such an entity is actually exempt from corporate income taxation entirely. And of course, that system have been introduced in order to attract foreign investments. Those rights have been granted to those investors, but by the end of the day, we could not see exemptions stemming from the directive or from Pillar 2, according to which those entities could be exempt from this minimal tax. So what Poland is now facing is how to make those systems working in a sense that not to place the foreign investors in a situation that technically they are exempt from taxation in Poland, but by the end of the day, they are forced to pay minimal tax outside of Poland, which is mainly calculated on the basis of tax-exempt income earned in Poland. So that's like a first group of entities which we believe might be affected. And at least for now, we do not see any measures presented by Polish Ministry of Finance how to prevent and how to mitigate this risk. And the second group of entities would be the holding companies, which benefit from the capital gains exemptions in relation to purchase and disposal of shares and other assets. Those participation exemption regimes existent not only in Poland, but also in many other European jurisdictions. And again, according to Pillar 2, that kind of income would be qualified as an income which should be subjected to the minimal tax, meaning that actually those capital gains exemptions would not be working anymore, or at least would be less feasible or less attractive for the holding entities. And the problem with holding entities is of course also the substance problem, because holding companies usually do not have substantial substance. They employ a very limited number of managers, and they do not run any other activity than a holding activity, which by the end of the day might be seen as non-sufficient from the perspective of exempting those entities from the minimal tax. So that's like a little bit of opening remarks from the Polish perspective, and I just very welcome your views and your comments on this.
Maybe just before we do, I'd just like to make one comment, and just it's probably more for beyond border members, because I realize we have a lot of people that may not be familiar with tax in Pillar 2. And just the way that I see Pillar 2, it's really a new minimum tax. So everybody in the world should pay tax at 15%, or at least the in-scope corporation. If the rate of tax is not 15, there's a whole complex system that will apply to kind of have other countries tax those profits that were not taxed at 15%. So I think in practice, what the OECD is thinking is that every country is going to increase their rates to 15% and make sure that their incentive programs are, say, achieve that 15% rate. So it's almost like the new normal is going to be a 15%. And that's really just because, like, let's say us tax planners have been coming up with tax plannings where you could shift profits from one country to the other in a way. So let's take an example. If I have a country where the rate is 30%, another country where the rate is 10, you could enter into transactions between the corporations in those two countries to reduce your rate from 30 to 10%, or at least lower it as much as possible. I think that's what the OECD did not like, and that's why they came up with a number of rules, including Pillar 2. So it's more in that perspective that I see this whole system. And I think that brings it to Piotr's point on the whole incentive programs, that a number of countries have incentives that were created to be able to attract capital, attract companies in those countries where maybe they would not go. And the best example that I have in mind is Barbados. Like nobody would go to Barbados, but for the low tax and the business-friendly regime. Now that you introduce that 15% minimum tax, why would companies go to Barbados? Like, does Barbados want to kill their whole economy? Or is there a way for them to kind of avoid the application of Pillar 2? So I'm just going to leave it there and probably opening up to the other 21 people in the room to see what's the perspective that you guys have from your country's point of view. I'd say maybe more on the policy point, and then we can get to the implementation or both together. Like I'll leave it up to you.
Hi, Shreya. I see you have your hand raised.
Hi. Yeah, so I'm happy to go first. I think Mark, it's actually a little bit more. I know you were trying to give a 20,000-foot overview, but it's actually a little bit more sort of complicated than that. And I'll go back to Piotr's point on how countries provide tax benefits in order to attract investors. Now, of course, there'll be some countries like Barbados, which would possibly not get these investors, but there would also be countries like Poland and India and China, which would have special economic zone regimes, for instance, which are specifically set up because for whatever reason. So for instance, in India, it was because there was a problematic history of post-colonial economic problems. We didn't have the infrastructure to be able to attract these technology companies and the FDI, and therefore we said we're going to introduce special economic zones. Now, the difficulty is that the way in which the tax base has been defined under Pillar 2, and this whole idea of refundable tax credits is an idea that enables only the richer countries to provide tax benefits. Now, how does this work, right? Refundable tax credits are essentially credits where the state has to provide cash to the taxpayer, and that's considered okay. But if you provide a special economic zone benefit where you say you're exempt for a particular period of time, that's an incentive that's not okay. So the question that I would ask is that everybody agrees that, okay, the 15% is this goal that we're trying to work towards. But how are we defining the tax base and reaching that 15%? And is the way in which we are calculating the tax base favorable to some countries versus other countries? Particularly keeping in mind that this was not an inclusive process, right? OECD put together these rules and then came to the rest of the world and said, these are the rules. Now you have an option as to whether you can opt in or not. But the consultation process in putting together those rules did not really involve a lot of countries outside the OECD until the rules were already put in place, and then they started taking in inputs. So this whole structure of refundable tax credits to me is very political. And I think we need to keep in mind that there's been a lot of discussion in the course of BEPS about distributive allocations. So how are you allocating the right to tax? And by introducing something like UTPR, essentially what has happened is that by a sleight of hand, you've taken away the ability of this country to give the benefit anyway. Now, maybe all of us come to the conclusion that that's something that we want to do because we don't want companies to be able to move only on the basis of tax benefits. But I think that needs to be a conversation, and that conversation has simply not happened in a way that, that is reflected in the form of Pillar 2. And I think that's part of what has made it quite contentious for a lot of countries as well.
I don't know if someone wants to go ahead or I'm going to talk again. And maybe, but more in general, I think while we wait for someone to reply, I think I agree with you that it's more the whole, even pillar 1, pillar 2, and the whole BEPS 1.0 and 2.0, I think has been done by developed countries and imposed on developing countries. So the system is kind of skewed in a way that it's going to advantage those, I'd say, to me, it's mainly the US and the European countries, because I don't think it's a good system for Canada either. But I think I'm just curious to see what other people think and if they have any view on what you just said, because I completely agree.
one maybe remark which brings my mind after hearing what Shreya was saying, that when you look to the mechanism how to calculate this minimal tax, you could see that they use the definition of balance sheet income, so accounting definition. Whereas in some countries, including Poland, you calculate taxes on the basis of own definitions set forth in the tax system. So that means actually, of course, we use the balance sheets as a starting point, but then we modify the tax result on the basis of particular regulations stemming from the tax law. So it means, upon implementation of those regulations, that we would need to provide like a double accounting for tax purposes, one for internal purposes and the other which is purely based on the accounting methods, which would be reported for the purpose of a minimal tax. So that is, at least from the Polish perspective, that is a huge change. And of course, I could not agree more with the discussion or with the conclusions, actually, that this is not something which have been welcomed by all European countries. This is welcomed by those countries which are well developed. Poland is, I would say, most likely less developed than some other EU member states. And that has been agreed on the level of European Union, although with specific restrictions and reservations made by some of the member states, which in particular relate to those incentives programs. And by the end of the day, we have agreed this last year, but after 12 months, we don't know what to do now. That's like a real challenge.
Shetong, I see that you've got your hand raised. You might be on mute.
Okay, now does it work?
Yes,
Yeah.
perfect.
I decided to just take off my headphones. Okay, maybe there's something wrong with the USB. Anyway, I mean, good morning, good afternoon, good evening, everyone. I think basically we have everyone across all the different time zones that's possible out there on the call today. I think I just wanted to share a bit on the Singapore perspective, and also I suppose get some thoughts. I think since I have the benefit of so many lawyers from different jurisdictions, from the European and also I think North American perspective. I think as far as Singapore is concerned, because I'm a Singapore-based tax lawyer, we are going to implement this top-up tax and the income inclusion rules, the UTPR and all this stuff. In terms of the timeline, we're going to implement it 1st of January 2025 and beyond. And I think the kind of issues that Singapore faces, I think it's quite similar to some of even within the OECD countries, where I think as far as economic growth and the policies are concerned, we are quite happy with things as it is. But because of this, this globe rules coming in and sort of, everyone trying to come on board, or they're trying to sort of make everyone come on board, Singapore in a sense is also, I suppose, not much of a choice. We're also coming on board. There are a lot of companies in Singapore that are going to be affected. But I think the question that I have in my mind, which I believe many advisors also have, is that even within the domestic tax legislation, sometimes things like taxable income and deductions are already so complicated. We are now introducing this whole complicated set of minimum effective tax rate, how you calculate it, refundable tax credits, etc., etc. There's so many issues to be ironed out. And I hear that in Europe, we have a 31st of December 2023 sort of deadline. There's a directive. But reasonably, and I mean practically speaking, is there any chance it might be pushed back, or will all the members of the OECD countries agree on how it's to be implemented? Because it still sounds to me, when I speak to international tax lawyers, that there's a lot of uncertainty in how it's going to be implemented. And a lot of countries are going to try to do their own things. That's one. Two, also, I believe the last I checked, USA is not signed up on this. So as long as they are not signed up on this, how much traction will this really gain? I mean, this is more like, the kind of questions that I have in my mind that relates not so much to the hard law, but to policy. But really, I think a lot of us across the globe, we are also second guessing or guessing what's going to be the next thing. Because as we all know, companies don't just move overnight. Everyone needs time. but everyone is also trying to sort of get their act together, or maybe utilize whatever tax credits possible, just before the deadline. So I just wanted to get some thoughts from, I mean, colleagues from the, other jurisdictions, I think particularly in Europe and also North America, since you guys seem to be leading on this.
Yeah, maybe I can quickly speak on something like the discussion that was talking about that we had on Pillar 2. That was at the International Fiscal Association North America Region Conference, so Canada, US, and Mexico. And as part of that conference, the person in charge of drafting the Pillar 2 rules at the Treasury Department gave a 1-hour presentation on what were the views of the US. And essentially, the person said, Pillar 2 is going to be implemented. We just need to work it out, but the US will be part of this. And then people stood up in the room and started challenging him. And like very senior practitioners from like New York firms were attacking him, saying that it didn't make any sense and that the whole view, and maybe I'll pass it on if we have someone from the US on the call, but the view was that this minimum tax is not essentially the whole world should adapt to how the GILTI works in the US. So GILTI pretty much is a minimum tax that the US has. And their view, or at least the practitioner's view, was that we should all adapt their rule. So GILTI should be a Pillar 2 compliant tax, and that it's all going to be settled. The US are going to be on board, and we should all have GILTI in our systems. And I don't know if we have looking at the list, I don't know if you have someone from the US who has a bit more perspective on the issue than I do. But essentially, I think that was my view of what the US were thinking. And I agree with you that if the US are not on board, this Pillar 2 is never really going to work.
But also, what does it mean for the US to be on board? Because doesn't the Congress have to pass it even if they end up signing it? And that's always been a stalling point in the past, if I'm not mistaken, right?
Yeah, that's right. For sure. I guess we'll see. I think we saw with the treaties, what is it? I think the Polish treaty took a while. The Hungarian treaty is now dead. And I think the prior one took, 20 years and it's not even implemented, or not implemented, but enforced. So I think if I remember correctly, I think it was Rand Paul that was stopping them all, and one of the US politician that was stopping all these treaties. So, but I don't know what's the political views on Pillar 2 now. So I'm not sure the Republicans will be very happy with that. I think I could probably quickly speak about the state of play in Canada. So Canada, pretty much like the European Union, said that we're on board with Pillar 2, and we will, we're very generally in Canada, the Canadian government has always been almost been a European country, and that we've been implementing pretty much everything from the EU directives and the OECD BEPS proposals. So I'd say that the plan is to have something compliant with Pillar 2 next year. But I think the main issue that we've been discussing internally in Canada with people from a number of firms is really the exchange of information. So I think that, to me, that's going to be one of the big issues. Like we say, the tax has to be 15%. But how will Canada know that India is applying a 15% rate, and that it's really computed based on the right set of rules that are contained in the OECD documents? Are we going to use the country by country reporting? Is it something else? And I think that's something that even the OECD is not really clear on.
Well, we do have country by country reporting in Poland, but it only applies to those jurisdictions with which we have concluded the double tax treaties, which is like 40-something jurisdictions, whereas all the remaining worldwide are not covered. So, I mean, that reporting would not fly very well, at least.
Yeah, so I think the big challenge is going to be, and I think we have less than 6 months, and we have to figure out how is all that information going to be shared.
Well, I mean,
And
I see a couple of challenges. I mean, that is some of them already discussed. I mean, first is like a taxable base, how to equalize the taxable base country by country. The second is the reporting, actually, how to get the information about the other jurisdictions. Because we do have only limited possibilities in this respect. And thirdly, how to cope with regulation with the incentive programs and of those exemptions which have been available so far and which are not covered by the exemptions set forth in Pillar 2. And I think that this last issue is something which is most, at least our government is most occupied with, because that is like a huge impact on our economy. If we would now need to give away the incentive programs, that would mean that probably the impact on the economy would be very material in terms of incoming capital.
And do you know how many companies are going to be in scope in Poland?
Well,
Like,
it has never been counted, but it's when you take into account the local, I mean the domestic groups, that is approximately 600.
okay, that's
600
substantial.
companies, yeah, but the bigger problem is with international firms, because I'm not sure if our financial administration has sufficient data to identify all of those who on a group level exceed the 750 million threshold.
Okay. Yeah, so I think a lot of questions, not a lot of answers, but I think that's what I'm sure all these discussions are all the same all around the world. Is we ask a lot of questions and no one really knows what the answers are going to be.
Yeah, which is why just now I was thinking, is it likely that definitely after 31st December 2023, Europe will, as they say, they will implement it in full, and without any hiccups, and everyone is on board? Because it is a big deal, and because Singapore is a very small part of the world, obviously. So we are also looking at seeing what other people are doing, of course, for our own selfish reasons as well, as with every country across the world. But how is it going to be implemented?
Well, I would say that from a European perspective, or at least from the Polish perspective, it is quite likely that we'll just, miss the implementation date. We have done it before many times in relation to other regulations. What we could hear from our government officials is that they are trying to implement it by end of this year, but without even giving us any draft of a provision so far, meaning that there are no consultations because there's nothing to consult about so far. So what I believe would be the case by the end of the day is that we will be in delay. And I would not expect those regulations to enter into force in Poland, at least sooner than end of 2024.
And in your country, is it that the UTPR has to be effective by, I think, the end of 2024, but call it the main rule by the end of this year? Is that it, or the plan was to have everything effective by December 2023?
Technically, the latter. I mean, technically everything should be, at least when we look to the directive which have been enacted in the EU, it obliged the member states to implement it by end of 2023.
Okay, because I think the distinction in Canada, at least our UTPR, so the under tax profits rule, is not going to be effective by 2024. Okay. So what I had in mind, if it's the same thing in every country, if there's no UTPR and no one has rules for the main rule, in practice, Pillar 2 is not going to be applicable.
Yeah, true.
Because no one will tax the income, either like internally on the main charging provisions or on the under tax payments.
Yeah, because I spoke to various people in UK, I think late last year, they were thinking that they were likely to implement it after 31st of December 2023. It was very likely. But I think they were, I suppose in Europe, they were probably one of the ones that are sort of more confirmed, I suppose. But But I know in Singapore, we are taking a wait and see approach, which is why we are saying that as at now, the official announcement is that we'll look at implementing it for fiscal year 1st of January 2025 and above, whether it's the UPTR or the income inclusion rule, the main rule. But yeah, but of course, we look at what's happening elsewhere before deciding. And like I think Poland, we also don't have the draft legislation yet. And I mean, just looking at the concept, I can just imagine that it is going to be very, very complicated. In terms of numbers, I mean, the government has not, I don't think the government has announced official numbers, but we also have quite a lot of companies affected, something like 1,800 or something like that, based on what I think some sources say on the internet. So it is going to represent a huge impact, I think, for Singapore.
I get it. I think same thing in that, like when Canada announced that they would implement Pillar 2, I think the Canadian government said it was something like a $2 billion additional tax that they will collect based on Pillar 2. But we then ask our Minister of Finance and have been in correspondence with the Finance Department to see how they came up with the $2 billion. And they could never give us calculations. And the main way is I think they look at the system right now saying what are all the companies that are paying less than 15% on an aggregate basis and kind of come up with a number. But what they do not have in their calculations is that other countries will increase their rate. So Canada will not have the right to tax the earnings of all those foreign corporations. So in our view, it's probably going to be tax neutral for Canada. From a collection point of view, and then it's probably going to be bad for the country in that we have a full participation system. So if we have a lot of, generally Canada is used to invest around the world. So let's say you have a Canadian company that has investment in the US, or I think maybe a country with a low rate right now, but say low tax country A. If the income is not taxed in that foreign country and it's active business income, we have a participation exemption that under which we can take those profits and repatriate them to Canada on a tax-free basis. So whether or not the profits are taxed at a 0% rate in that country, on $100, there's $100 that can be used and redistributed in the Canadian economy. On the flip side, if you apply Pillar 2, that low tax country becomes a 15% rate country. We only end up with $85 that we can redistribute within the economy. So our main view is that it's probably going to adversely impact the Canadian economy. Because there's no, like, we're not a country like the US that is being stripped from its profit through those financing structures or other ways to reduce the taxable income. And I think that's the case for a number of countries in the world as well. Probably like Singapore.
Yes.
And in Europe, that might be the case for Netherlands and Luxembourg, which are qualified as investment hubs. When you have a lot of intermediary firms who are holding entities who are set up for the holding purposes only. So I believe the conclusions in Netherlands would be quite similar.
So we have a very, very similar system, and I can tell you a lot of our rules, they're based on the Dutch rules. You take the Dutch, you translate it, and it kind of looks like the Canadian system.
The Dutch have been sailors for centuries, so they just spread their system worldwide.
Yeah.
So on the Indian side as well, similar implementation uncertainty. We hosted the G20 meet in India about a month ago. And so all the G20 countries came together to discuss how Pillar 2 would be implemented, but very little, that is concrete seems to have come out of that. In our budget earlier this year, there was a lot of anticipation that there would be a roadmap introduced for Pillar 2, but we didn't really see too many provisions coming in along those lines. I think one of the difficulties that we're facing is that Pillar 2 itself is evolving, right? So where it is today is very different from where it was, say, 6 or 7 months back. And I think that makes it quite difficult to plan when you're trying to set a plan in place. I think, Mark, you mentioned as well, right, that it takes time to make these decisions. And when you're working with shifting sands, then how really do you take those decisions? So I think that's where we are as well at this point.
And maybe to move the conversation a bit to client work, like how have you guys been communicating that information to client, and what's the, I don't know, the view of those clients in your countries? Like, are they planning for Pillar 2? Are they still waiting? Like, what's the general view on that? Because I think it could really affect a lot of our clients. But at least for me, I'm not sure if they're fully aware of what that impact is going to be.
Oh, I've mentioned in the beginning that in Poland we have quite a lot of foreign investments, so we have quite a lot of foreign groups, foreign capital groups coming with greenfield or brownfield investments here, and they do have knowledge about this Pillar 2. They are quite afraid of it because that makes their calculation of profits very difficult. They also, that of course makes tax leakage in Poland higher than expected, even deciding on the investment. So they are really like a standby modes, and they are waiting for the feedback from the Polish government how those rules are to be coped with the current incentive system. What we are going to do about that, because that would like financially affect the particular investments. But they are, I must say, they are quite aware. And they are quite afraid. Yes, at least for the last couple of years, changes in the Polish tax system have been quite aggressive from the perspective of tax administration. So we try to tax as much as possible. We have been considering to introduce our own national minimal tax system, which have been stopped by the European Union because of adopting the Pillar 2. So that is the level of awareness of the clients is quite high, but still the advising in this respect is difficult because there's technically nothing to be advised about on the level of a national legislation.
Good. And do you think that's going to give rise to a lot of restructuring or companies leaving Poland for other European countries?
I'm not sure because we do have like greenfield, brownfield investments. It's not that easy to leave Poland. You will not just take the factory away, but for sure we are thinking about simplification of the structures. So simplification of the holding structures, liquidation of some of the holding entities. That is something which is being discussed about for sure. But again, that we expect that to happen more oftenly in the second half of 2023, when finally we expect to see some legislation coming.
Does anybody have any views in their countries?
Hi,
Yep.
my name is Christina. I'm from Venezuela. I wanted to say a few comments on what you have said. Regarding the implementing date, I think I totally agree that the countries are going to delay as much as they can and maybe wait and see how other countries are implementing it before they take any actions. And regarding the restructuring, we've seen a lot, not just with these pillars, but maybe with the low tax jurisdictions changing, implementing the economic substance things and activities that now you have to carry in those jurisdictions, that has had an impact as well. And clients are, well, for example, our clients are already like in high alert that they understand that things are changing and that it's not the same as it was maybe 5 years ago, 10 years ago. And it's just something that's happening, and the changes that are happening in the jurisdictions regarding tax-wise. So I think maybe they're not like fully aware of the consequences that this will have, but I don't think it's going to surprise them when once again to go to them and say, maybe, well, you have to restructure, or these are the consequences. And that's a risk that comes when you implement a structure. It's not likely to be permanent, and it's likely to change in time.
Get it. It's probably more, I think the economy in Venezuela is probably a lot of companies investing in the country, like for oil and gas and.
Yeah, that happens
Is that right?
a lot. and a lot
Probably
of,
more than the opposite. It's probably inbound more than outbound.
yeah,
That'd be right. So
totally.
probably the impact is probably a lot bigger.
Yeah. Yeah, it happens. And a lot of clients they have holding companies outside Venezuela to take advantage of this foreign currency, income tax exemptions and everything. So yeah, that's what we see here normally.
That's interesting. I don't know if I think we probably have like 6 minutes left, and we're probably going to take 2 or 3 minutes at the end just to close. So I don't know if anybody wanted to make any comment before we do. But now is the time. No, it doesn't look like it. So maybe I think generally what we've been doing for the last 5 minutes of our meeting is try just to come up with ideas together, the whole group, to say, what would you guys like to talk about for the next sessions? Like obviously all the beyond border people, you're all invited to the next meetings if you're interested. So feel free to propose other topics, but generally like we try to come up with topics to make sure that something interests everyone that's going to be joining. Anybody? Like it could be, I think I'm sorry, and I should have explained that generally the way that we do it is there's one meeting where we do a private wealth type of session, which is more, could be tax, but it could be other rules related to like private wealth, estate planning, and more private clients. And then we alternate. So that's a private wealth. And then we do, for the next session, we do a more international tax session, like the one that we had today. So the next one's probably going to be private wealth, and the one after is going to be international tax. So you can propose subject for either or, and we'll try to fit it in the schedule. And I think Anna, is that right? It's on the forum that we have the date for the future meetings, or did we not set them?
We do have, and let me just pull this up from our website, Mark, because we do have the next meeting set, I believe, for September. But I'm going to go to our website really quickly and look that up and drop it in the chat for you all. But yeah, this group is the tax and private wealth, so it does cover both areas. And if there's something, that you're either working on or you're seeing a lot from clients that you want to either hear from others on or lead a discussion on, please do let us know.
So I got it right here, September 27 at 9 p.m. Eastern time. So I don't know, you have to work out when that is for you guys, but it's like 12-hour difference than for this meeting.
Yeah, and we do try to, another thing we try to do, since we are, we're World Law Group, so we have people all over the world, we do try to shift the meetings and when we host them. Our other co-chair for this group is from Wong Partnership, Bach, and she's more on the private wealth side. So she will likely be leading that meeting in the fall. But let me copy that link for you guys, and I will drop it into the chat so that you can sign up for that as well. And I would like to sort of echo what Mark said about the Beyond Borders folks participating in those future sessions. Don't just stop, and I know some of you have already heard this spiel from me in previous sessions, but don't just stop your participation in World Law Group when Beyond Borders ends in 2 weeks. Please continue to join our practice and industry group meetings. And if you have been writing articles, upload them to our website, or if you have an idea for a session, whether it's tax and private wealth or it's something else, don't hesitate to reach out to Ashley or me or any of the team or any of the practice group leaders for that matter with ideas, because you guys are the future of World Law Group, the young lawyers are, so we want you to be engaged.
Perfect. So I think with that, we're running out of time. So I'd say maybe if you have an idea for a future subject, just send us an email, or you can also post it on the forum. I know our group has not been very good to use the forum on the World Law Group website, but if someone wants to try it and be the first one to do it, please go ahead.
Yeah, and so when he says forums, the discussion board, you can, the discussion boards that we have on the website. So if you're logged into the website under your name at the dropdown, you can go to discussion boards, and you're automatically signed up for a discussion board if you've signed up for that particular practice group or forum. So you can add yourself to a forum so that you can participate, posts. If you want to start a discussion, please do so. And the other thing is, if you happen to be attending, I know IFA is one that Marc-Andre has attended and sort of co-hosted with the local firm a meetup at. If you're attending any sort of industry conference, please let us know, and we'll that's a great place for us to post, is on that discussion board, to find out who else from World Law Group is attending so that you could actually meet in person.
Yeah, like I said, like we in IFA in Berlin, that was great. We had about 30 people from the World Law Group. So we held an event where I think we had food, foosball tables, and beer. So that was a lot of fun.
And we are trying to do something this year. IFA is in Cancun. And I am working with our Mexico member firm, Santa Marina Esteta. It's a little more challenging because it's a resort destination and not where the firm has an office. So we're trying to come up with something unique that we can do for our members. So if you are attending that, please let me know, and know that I am working with them to get something on the calendar.
Great. With that, I think it's 10 o'clock. So thank you very much for joining.
Yeah, thank you. Thank you all.
Thanks, everyone.
Thank you.
Yes.
Thanks,
So,
everyone.
We'll see everybody in September.